All right, in this episode of Investors and Operators, I sit down with Sheryl Mejia, managing partner of Steward Asset Management. Steward is an anchor investor to emerging private equity and opportunistic asset managers targeting a Fund 1 launch. Sheryl, it is awesome to be talking with you today. And I want to kick off and just, if you could share a little bit about your background kind of before starting Steward in 2019.
Great. Thanks, Jordan. Thank you for having me today. It's really great to always, spend time with you and your team. So I've been in the investment industry for more than 25 years and had the pleasure of working on big and small teams, some of the biggest and some of the smallest. And you can contrast where you've learned more and where you've learned less. And sometimes seeing everything that goes into the cooking is helpful, and sometimes being in a silo builds up certain muscle strength. So, but I started off at KPMG in the tax and audit department before I did my MBA at Wharton, and KPMG was great because it really got a baseline on great operational controls, which has sort of served me through the life of launching and growing different emerging managers, and of course currently as we're anchoring brand new ones. But the MBA program at Wharton was less than 20% women when I was there in the 90s. And so it's much more than that today, which we're so pleased to see. But then I had a chance right afterwards. I was invited to join Bankers Trust Company at a time of incredible innovation in the capital markets, and when we were defining a lot of the terms we use now, and especially in the private asset classes. And I worked with David and Vera, who are on my team today at that time, alongside them in the asset management unit of Bankers Trust, which was ultimately bought by Deutsche Bank, which sort of the first lesson of what happens when you're a medium-sized fish and bought by a larger fish, and how that was being flexible and adapting to the new culture, which I love Deutsche Bank. It was also continued the culture of Bankers Trust, the best of both. And ultimately, as I rounded out a decade at Deutsche, it was time to do something entrepreneurial around the time when I had my kids. So I needed a teeny bit more flexibility. And but it was great. I did a combination of things, but ultimately culminated in Vera and I co-founding Decagon Advisors. And it started as us helping one fund of funds, KCS Fund Strategies, but ultimately they became the first client of Decagon. They had actually also been clients at Bankers Trust, so it was a continuation of the same team. And Decagon was an investment consulting firm at its core, and but we did the diligence on managers that were smaller and nimbler that some of the large consultants were really equipped to cover because they.
So were you primarily focusing on like investment consulting for like small buyouts, or what was your specialty?
So yeah, we were investment consulting to pensions and fund of funds. Okay. And so we would help them with their fund allocation. So yes, I've been a fund investor primarily most of my career. And so yeah, the smaller private equity, growth equity, venture, and also many alternative strategies, distressed, long short equity things we covered in that area as well.
Maybe before we could dive deeper into the career, what was your first job?
Oh, my first job? My very first job?
Very first job.
I was, because I was under 16 and I was sort of hankering to get into business, I convinced my mother or she convinced me, I don't know, some combination of that, to sign up to be an Avon lady. I couldn't sign the papers myself, so she signed them for me. Actually, today's her birthday. She's unfortunately passed away about 15 years ago, but today's her birthday, so we can celebrate strong mothers.
So she nudged you into becoming an Avon lady.
Yeah, so I think she saw that I knew most of the neighborhood already, so I was pretty social, and so she's like, okay, let's turn this into a profit and get her, out of the house, making some money.
Move you a little bit more to the asset column as a kid.
Yeah, exactly. I don't know if I consumed I don't know if the profit margin was actually as good, because I was a consumer as well. But, I did fun because we were in one of those neighborhoods where we were expanding, they were building, it was a subdivision, they were building more and more houses. So I was actually one quarter, I was the most, one of the highest growing salespeople for Avon at the ripe age of 15. So
Well, where did you grow up?
Toronto, just outside of the Toronto area, and
Okay.
in Mississauga. And so
Nice.
that was a fun time there, and that was a growing community and still a very vibrant area. It's actually just a super place to grow up, nice and calm. But my mother was American, interestingly enough, and so I ended up down here in the States to do the MBA and then continued on. But Jordan, to just truly answer your question of the career, I mean, the notable thing, the most exciting thing was working for Tom DiNapoli and Vicki Fuller at New York Common. We haven't covered that, and so.
Yeah.
I
So,
know.
so it was Bankers Trust, which was bought by Deutsche Bank, then KCS, then Decagon, which did investment consulting
That's
for
right.
pensions, et cetera. And then the
Okay.
next step was New York Common. And yeah,
Correct.
I'd love to, what were you doing at New York Common?
So at New York Common, I stepped into a very interesting role, and there's only a few of these roles in the country where you're responsible for the emerging manager program. And there's some notable folks in the industry who've really helped me step into that role in a strong way. And Sylvia Bell at Texas Teachers was very supportive. She'd been through a lot of the things, building a great program. Clint Stevenson was also building out his program at CalPERS at that time. So we were in the collaborating in some of the build out. And so over the years I was there, we grew the emerging manager program from just under 5 billion to just under 8 billion in exposure, and that's NAV plus unfunded commitments. And we really extended its reach. And the Tom DiNapoli, New York State's controller, is such a strong proponent of diversity, but also that it's going to be absolutely in the strongest form of asset management, really bringing up the new leaders. So with Vicki Fuller's help as CIO, we really found ways to understand how we'd been successful in the past, and also just extend that runway. And really, it created a focus on the private markets.
When do you think that emerging managers as a dedicated function and segment really started to evolve within the pensions, endowments, and others in the LP universe?
It's interesting. Just about 10 years ago, maybe a little bit more, when Tom DiNapoli, and at the same time the Texas program began really focusing on realizing it was a specialty. There were special considerations in underwriting smaller and newer managers. And Jarvis Hollingsworth is sort of and Tom DiNapoli, I think of as the godfathers of being a leader and stepping out and really making that happen in different programs. And then producing reporting that actually uncovered it for other people.
What are there any kind of resources, either websites or particular like annual reports about emerging managers from LPs that you think could be interesting and useful?
There's so many resources now. New America Alliance, NAIC, and the actual pensions do a good job of putting out materials and reporting. And New York Teachers does an annual report, or a semi-annual, every other year annual report.
Well, let's dive a little more let's dive deeper into New York Common. So you went from 5 to 8 billion of allocation to emerging managers, but like how many emerging managers were you working with? And like also, like, how do you define, how do you define emerging manager?
That's right.
When have you emerged?
When have you emerged? So I often think of emerged as hitting $1 billion in AUM in the private markets, and generally if assets under management or asset capital raised or fund size in that range. And so we were typically targeting fund sizes that were between 150 and 500 million, fund 1, 2s, and 3s.
Okay.
And that is a critical moment where the teams are typically taking skill sets and track records from prior shops and creating their own shop. Now, the We had 120 managers overall in the entire program. 40 were in the public markets, and that we had allocated on a discretionary basis to some of the program partners. On the private markets, that's where we worked most actively to implement great governance terms as we were entering the managers. That can be a delta to new managers who are coming on. They may not know exactly the institutional terms. We always had to implement our own side letter conditions. And then, of course, we would at times participate in their success, like we do at Steward in the Anchor program, but in a smaller way, because we were often later. We weren't the catalyst to their first close. We were often in the last close or in the fund two, which was where the pension programs are often more commonly seen. Sometimes they can be a catalyst to fund one, though. So that's there are certain conditions, but it was a great time to really at rigor put a pace to allocating to private equity and opportunistic and programs. In real estate, we had more of a discretionary relationship at the time I was there with Artemis Real Estate Partners, which we absolutely had a super relationship with, and really appreciated their underwriting approach and everything else they did in the industry for advocacy around smaller, newer, emerging, and diverse teams.
Speaking of diverse teams, out of the 100+ emerging managers you're working with, approximately how many were considered diverse? And then, how do you think about diversity now with the, however many managers you're talking with in your pipeline?
Sure. It's well, the work at New York Common laid the groundwork for our pipeline today. So at New York Common, across the entire portfolio is where I had the statistics, but we had about more than 70% of the teams were more than 50% owned by women or various minority groups that are defined by New York State as typically Black, Hispanic, and Asian owners. And so the program was really amazing at the quantity of talent we looked at. So we looked at the whole universe and really tried to put together a portfolio that would be high performing. And I'm very proud of the performance we had. We were able to realize there. And but really, with more than 70% of the managers comprising diverse teams, that many of them have gone on to have $2 and $3, $4 billion fund sizes and graduated out of the program and are now new leaders on the leaderboards as you see the rankings of the top private equity firms in the industry. So the importance of that function, though, is the ability for new entrants to help mitigate some of the concentration we're seeing at the largest private equity managers that just continually do larger and larger deals. And the importance of part of the equation of that return of that portfolio, and the success there was that it was able to do smaller check sizes and those managers can do smaller deals. And it's absolutely critical that capital flows to those middle market companies that are really underserved and incredible value for the growth equation.
Well, I think that's a good segue into, Steward. And I mean, why leave a job that you really liked and are having, and you had a tangible, significant impact on that particular part of our industry? Why leave and start an entrepreneurial venture?
So, we all have biases. And so, this is part of the study of diversity and biases but I have a bias that I really like smart and remarkable people. And so, and it's the most exciting to be with them at the time when they're making that transition to launch. But at the same time, Steward, just like at New York Common, we couldn't get access. We couldn't get the best equation of fees and reduce the fee burden of private markets at the stage with which we were engaging with the managers. And so there's a better equation, and many family offices have discovered this for the last few decades. And the institutions have sort of been late to this game, not game, but late to this getting access to managers at launch. And because many of the providers have conflicts and just don't focus on it. And don't have the dedicated bandwidth that we do at Steward. And so we really allow
the LPs don't have the bandwidth to really effectively find, assess, and participate in emerging managers.
Correct. And so it takes more than just understanding the limited partnership agreement or the side letter you may engage with the manager. We actually institute a lot of controls through our anchor partnership, strategic partnership agreement with the manager, so that we can anticipate various outcomes of their business, and of course be there as a strategic partner participating in their success, which helps to lower the cost of our investment completely, or seeks to do that. But more importantly, allows us to engage with the high performing teams just as they're spinning out, and it really extends the reach of institutions. And so we prefer a commingled vehicle. We also offer SMAs, but the commingled vehicle allows us to act quickly, be a competitor in institutionalizing anchor capital that's directed at teams that are leaving their job and looking at an uncertain future of 2 to 4 years, where they may have to fundraise before they can get a first close complete. And that dissuades a lot of teams. I joke that it's easier to get capital for a non-revenue producing, almost inexperienced team that's starting a technology venture in San Francisco than it is for a 25-year veteran team of 4 leaving a large private equity firm to launch their own firm.
Why is that? Why is it that the venture community has institutionalized anchor investing, seed investing, but the private equity the buyout markets have not institutionalized seed investing, anchor investing?
I think it's been a nice secret the family offices have held on to for a very long time. These managers, it's a little more work to underwrite them. So some of the biggest institutions that serve the largest pensions that have been the home to the emerging management programs have not aren't able to spend as much time on these smaller managers. And so it does take a number of new offerings. We're one of a few competitors that are in the landscape today that are trying to get more out of the private equity program, and also make sure we dive deeply into the middle market to make sure we're looking for great growth stories. So is
it needed? Like, why? What is the gap that is being filled? Why do we need to institutionalize this? If there is the system not working for emerging managers? Are we getting the best emerging managers?
The system is broken, and in this particular, there's a gap. There's just a gap of capital. I think there's an awareness gap to start with, where it's like your recycling program. Are you doing the right things to make sure you correct your carbon footprint? I think there's still work to be done here, and we're actually finding that the boards that we're presenting to and talking about our strategy, have an aha moment, like I did at New York Common when I was asking our team, can we go earlier? Can we get more of the economics? Can we participate as this manager grows? We've been there. If we're their first check, we're more of a strategic partner. If we're a first and larger check, most importantly, can we be a meaningful participant in that team's success? And so at Steward, we often participate in managers' carried interest, which helps offset the fees. And so it's a new opportunity especially for pensions who are very challenged in looking forward, thinking about how they're going to meet their funding requirements and not reduce their return hurdles or return expectations, which then, of course, goes straight back into the teachers and public employees that we care so much about in our communities. We don't want to charge them more to contributions to their pensions. We'd rather make sure the pensions have an equation to increase the return profile. I use pensions as an example. Our investor base will likely be many more investor types than pensions, but it's the one I'm most acutely aware of the complex accounting equation around.
Interesting. Let's pause for 1 second. Well, so let's go to the kind of the next logical question, which is, like how do you sort through the best emerging managers? Like, how are you identifying the ones that are a good fit for what you do?
Right. So, Jordan, as you know, we're often the first check to Fund One, and so we don't have prior funds to look to. So we are building a bridge from a prior set of data and positions, and often the team is worked together. Our team sees more than 200 managers a year. Especially over the last year, we saw more than that. But we right now have an active pipeline around 50 managers that are in some stage of review, and of course a number with term sheets right now that we're looking to get done by the end of the year. And it's really proprietary sourcing. We are very vocal about what we do. We're very targeted. Being solely focused is very, very helpful. They know we are one solution. We have one pager we share with them, very transparent about how we're approaching this and how we're trying to serve our limited partners' needs in this equation, in this economic equation that we're just trying to solve for, making sure they get to market, but also making sure the limited partners participate in that success that they're helping to create. And so in terms of finding teams, David and I are the two that really spend the most amount of time calling and screening through to make sure we're finding teams that are going to bring unique expertise, a strategy that's really opportune for the moment, and just really have that ability to go to market and create relationships that are going to matter for many, many generations of funds. Often our role, so we have an outreach. Our role is really also not just sourcing, responding to inbound, but we're watching the talent pool in the industry and really looking for those teams that are likely to not have as much glue together, really make sure that some of the highly qualified and very successful deal makers have that opportunity, and it's maybe a shorter runway than the traditional 3 or 4 years to launch a firm. And we're trying to look for those teams that are looking for that strategic partnership. The nice thing is, and it's very, very helpful, that our team is a diverse team, and we look like the United Nations. And so with that, I think when you're doing these very difficult, very pivotal transactions, you are looking, there is an affinity bias. People, deal makers like to do deals with people who look like themselves, and it's very, very helpful. It's one of the ways I think the diversity on our team sort of creates an alpha, in addition to us being able to create and source teams that are diverse, allows us to fill the need.
I think you're hitting on an interesting point, right? Which is, it's a heuristic. It's and it's outside. It's in every aspect of our lives and how we make decisions, and it's easier and it's a higher probability. The heuristic is that it's a higher probability of success if I work with people who are like me in some way, shape, or form. And so you just have to change who look like we is. But that just came out as completely incorrect. I can't speak English or human today. So if you have a team of 10 white males who are in their 40s, 50s, and 60s, then they're, the statistics show that they typically back people who look like them, who have a similar background, similar schools, similar pedigree of firms they went to. So that means you just change the teams who are doing the choosing, and that way it's more diverse. I know at New York Common, you're saying something like 70% or so of the managers that you worked with, the 120 were diverse. I mean, in your pipeline of 50, like, how are you thinking about diversity?
So without making an enormous effort, or just because of our sourcing channels and maybe our lens, and we know how important it is to the largest institutions who will follow on with capital, our pipeline is more than 40 out of the 50 are led by diverse team members. And sometimes it's 1 out of the 3 on the investment team, and sometimes it's 3 out of 3 on the
40 of the 50 would be considered. That is fantastic.
And interestingly enough, of the managers who manage funds that are greater than $1 billion, there's only about 15 of them in the world. So in the private equity industry total, of all the managers, of the 300 managers that manage funds over $1 billion, there's only 15 today. So we hope to really change the landscape in the next few decades.
Out of the 300 or so in the US or globally?
Globally. The US is very dominant though, so it's easy to, it's
So
easy
out
to
of
say.
300 globally that manage over 1 billion, 15 would be considered diverse.
Correct.
This is really interesting because, I mean, you're at the very beginning of the funnel.
Mhm.
And so it's, that's really interesting. So let's go back into more like, how do you choose the managers?
Yes. So we're really looking for teams that can scale. Some anchor investors are looking for niche, and that those tend to work with smaller wealth management platforms that just really love that niche strategies. We're looking to build. Our team is equipped. We've sort of brought together 8 principals and 4 advisory board members, each with, I mean, many have more experience than I do, and really, it's a purpose-built team that can support a manager through our underwriting, during and then post through the value add. So we are looking teams that are bringing together, likely have worked together, have a strong history, a track record of deal making that goes back a number of decades, and proof point that they've participated, but also led deals from start to finish, and that those criteria are really our first stop talking to a team. Of course, a repeatable process and proof point that they can repeat the success of the past. And so as we build this bridge, we're looking for, of course, there's always classic diligence, whether you're looking at Fund 1 or Fund 10, is people and process and performance. But we add a special unique lens for looking at Fund 1s, especially at this early stage before they've had the first close. It's called a foundational assessment of the firm. And it thinks about things like, is there shared ownership? Will this team stick together? Is there a common mission, an understanding? Who's capitalizing the firm? Are they putting enough of GP commitment capital into the first fund? Things that are foundational decisions of creating these managers, and are they putting in good operational procedures from day one? They don't have to have everything in place to transact with us, but we build a 3-year plan for the future. So we'll put in place over those 3 years things like an ESG policy. They don't have to have it day one, but we will be there to guide them and help them in areas where they would need help or like help. And so with our operating partner team, we help to also support their transactions, because one of the things that Fund 1s typically slow down on is their execution pacing of deals, because there's a lot of distractions when you're setting up. And so that is the valley of death if you slow down your execution pacing for Fund 1, because Fund 2 really is raised based on strong realizations in Fund 1. So to get to realizations, you have to initiate. So it's a whole set of dominoes that we've seen this pattern and again and again. And so we're hoping to make sure we help support that process. And our capital.
Is ESG policy a requirement for you to invest in a fund?
No, not at all. We're sometimes it's easier to watch the process for a while and then find areas where there are more risks or opportunities for them to be advocates than we first can see initially. So it's actually good to live with your ESG policy for a little while, your ESG lens, and really get it right, make it authentic. Really many of the largest institutional investors are asking, yes, it's great to write a policy, but is this being incorporated in your review, your review and compensation of your team members?
So to that exact point, another firm, Anagenesis, with Melanie Brensinger, we're actually going to record an episode on this, and she was saying, like, we now have community impact as part of your performance review. And so the first time they did it, like, everyone on the team literally got like a 0, and then the whole team, right? Well,
Exactly.
Because she was saying, like, high performers, when they see a 0 on something, they want to go to a 10.
Yeah.
And so it's interesting. It is. we don't have to have it in, in the foundational documents and as highly institutionalized things. You take quick action, and, ESG is like, what are you going to do today to help somebody out? And then build on top of that, and it becomes firm policy. But it was just fascinating to hear her talk about, they didn't have that in their performance reviews, and everyone got like a 0 when they finally did it, including her. She's like, oh man, we all have to do something.
Mm-hmm. That's exactly. There's so much work to be done in those areas, and we're all learning how to be better, how to be less biased, how to really think about the risks and returns, longevity. I mean, we've all seen climate and healthcare risks over the last few years, and how do we make sure our businesses are sustainable through all of these both cultural and environmental challenges. So we're working hard with the managers, especially early on in a life of a fund, you're doing a lot of work on vendor selection, right? You're choosing your auditor, you're choosing, and it is really important to start thinking about diversity at that stage as well. So are you making sure you have a diverse candidate pool in the mix? Are you asking those vendors about their policies? And so it's interesting, the CFA Institute did some great work around thinking about diversity and inclusion in your team. So we've had a lot of great resources available to us that I don't think was available in the last generation. That's why I'm very excited about us being able to set sail new strategies that are classic strategies. I mean, healthcare, industrial, consumer, technology, strategies that, but make sure they're flowing through with best practices and getting launched with that stable foundation.
Yeah. What are typical GP commitments? Like, what is the industry benchmark now on what percentage that they need to contribute? And has that changed over the past 5 and 10 years?
So I think there has to be alignment. The goal with GP contributions alignment. The traditional is 2%. But if a manager is going to contribute 2%, but finance most of it with availability of Silicon Valley Bank or Grasshopper Bank or one of the providers, maybe you'd like to make lower that a little bit and ask for other terms as well. So that we actually have a strong specialty in getting through an initial LPA and side letter and thinking about very logical terms for that team's individual wealth levels. And it's interesting, in the industry has traditionally been forming a new emerging private equity firm has been a wealth screen versus a talent screen, because you have to last 4 years without a salary, do some deals in the warehouse and contribute some capital to those. And then, by the way, congratulations, you've just raised a $250 million fund. Where's your $5 million GP commitment? And so it's this, who's saved $25 million, which teams have saved $25 million in the bank, who can afford to do this. And in some way, that's an indication of success. On the other hand, it does limit certain teams from, or scare certain teams off from launching, when if they had a strategic partner, and we're one of many options as an anchor investor, that they could have a more assured path to that revenue starting, so that bankruptcy won't appear before first close of fund one.
Oh, the entrepreneurial struggle is real, whether you're doing a small tech startup or you're raising a $250 million fund.
Yeah, exactly.
And I think that's a really good point about the wealth screen versus the talent screen, and why anchor investing needs to be institutionalized, to see multiple levels deep, to really find talent and allowing that talent to flourish. And that kind of makes me think of the topic of small buyouts, which is, in the grand scheme of things, why do pensions, LP, and other types of LPs, need to focus on smaller buyout strategies? Do they outperform? Are they better? Or what's the big picture here?
Yeah, it's interesting. In my travels, I've noticed a couple of different types of investor groups, and some that are so large that smaller funds are just barely on their radar, and they're uneconomical because they have, they feel like they need to use a fund of funds manager. Others, some insurance companies, they absolutely focus on small buyout strategies, and they realize the incredible value equation and higher growth possibilities of a small buyout. And just to give the numbers around that, so if you think of a $250 million fund that typically writes equity checks between 10 and 30 million, either as a buyout or a growth equity investor, as a minority, control or a minority stake in a small industrial company, there are very few equity checks at that industrial company, often family-owned, founder-run businesses. There are just not that many sources of capital for that size of business, and it's sort of it's a tweener, right? It's not a new startup venture business, but it's just a solid business, possibly with 10-15% growth, and even more if with the help of a sector specialist buyout team can come in and bring that knowledge and capital equation together and help that team professionalize and explore new markets. And ultimately, small buyout is a market that's, focusing on the U.S. middle market, is a market that's still trading often less than 10 times earnings, but has growth at double that of the S&P 500. And so it's this market of, the middle market has over 200,000 companies in the U.S. alone, and they often have very small market share. So you just start with a lower base of market share, and there's just incredible levers to grow, both through partnerships with small buyout and growth equity managers, but also just on the company organically. And so it's interesting because it's really the old-fashioned way to invest, and with less leverage, straight into the company, equity interest in companies that are already profitable and just making them more successful. And
you're focusing on small buyouts. Small buyouts focus on these tweener companies that are profitable, that are growing, and that are kind of like the backbone of the US. And so it's really a focus on, the lower middle market and making sure that every part of this has the capital to do what it needs.
Absolutely. And even the banking institutions aren't really equipped to provide loans on a consistent basis to many of these companies. If you have a solid asset base in your company, they can be more, the banking relationship's a little bit easier. But that equity check that comes with a team of experts in your sector with prior experience in other companies is invaluable.
How have you thought about putting together your team? I mean, you're doing your entrepreneurial venture. you're backing entrepreneurs, but how have you thought about the team that you've constructed? Like, how have you known the team, et cetera?
What's our foundational?
Yeah, what's your story?
It's ourselves on our foundational assessment. So we, of course, used the recipe book on ourselves. We brought together 8 principles and 4 executives and 4 operating partners. But 3 of the operating partners are also owners of the business. So we shared ownership across 7, and we share carry across all 12. And we're building something to last for many, many decades. We've had great partnerships. So ultimately, the team started as a base of us that knew each other in the 90s. I think 6 out of 8 of us knew each other then. And 3 of us worked together at Bankers Trust, and 2 are other specialists in the industry. Our operating partners, Wayne Nemeth, who was at Sprout Group in growth equity and late stage venture in the 90s and early 2000s, and Christine Kwok, who was at Goldman and Shorenstein in real estate and real assets and credit over those years. And they join our investment committee. David and I are the executives on the investment committee. And David, actually, he was one of the founders of Brookfield, a team that spun out of Bankers Trust and ultimately sold the firm to Morgan Stanley. So he's been through the startup, right through to selling your company, your asset manager, to a larger shop. So he's invaluable at understanding the mindset of the entrepreneurs. And so we've built the team. We've been so fortunate to have Erin Shippey as our Chief Operating Officer. She comes with 20 years of experience at Royal Bank of Canada, and she was on the other side of the table from Christine Egan and Vera and me over the last few decades, because her platform of operational and portfolio at Royal Bank of Canada supported some of the clients that we had at Decagon, and it was a very nice collaborative relationship. So it's great to have the team back together. I had left Decagon to join ER Common, and I left Vera and Katsura Kikuzawa in charge of Decagon. They did a great job continuing the client relationships, but then we turned Decagon into, we finished the relationship with external investors and clients, and is now solely dedicated to operating just at cost services to help the portfolio of Steward companies.
So how long has the team known each other, like the core team?
94. So
all right, well, we won't do the math on that.
25, 26.
Well, I guess kind of my last and favorite question is, what is your why for being an entrepreneur?
Mm-hmm. Well, I mentioned a little bit before, but if I have a bias, it's about smart and remarkable people. And at the same time, I actually couldn't believe when this sort of idea started incubating, and there was the help of some very, really helpful members of the Private Equity Women's Network, PE Win, were super helpful in helping me think through. And I wasn't sure when we've had the idea that I would be the one leading it. I thought I would introduce this idea, and someone else would, one of the large private equity shops would take it on. But as it became clear that there was a gap in the capital markets, and especially one that is so important to the United States and its leadership in asset management, that we need to continue to be leaders. And yes, private equity has been a dominant industry for U.S. growth and capital markets, but it's becoming increasingly concentrated. So we definitely need to find support for new entrants and get that capital to those important middle-sized businesses that are some of the largest employers in the country, and when seen together. And so I just but I love every day. I feel like I have the best job in the world. I get to meet super smart people at the moment where they're at a high conviction time. They say, I'm about to leave my job. I'm going to leave security, and I'm going to change the channel. And we're going to brand. I mean, many times talk to teams, and they haven't even picked the name yet.
This has been awesome. We have a shared love of working with emerging managers. I'm on the marketing and branding side and the video
That's
side.
right.
You help provide money to them. No, but I love working with emerging managers, and I think it's because so much of my career, especially in the past 5 years, has been starting something.
Mm-hmm.
And that stage of a business is so much fun, even though it is equally challenging, because you're figuring it out. Like, what should we call the name of our new industrial focused buyout firm? I don't know. Let's look outside. What's the name of that river? Or like, who's doing IT? I don't know how to even turn on my computer. You can do it. Like all these things. Like when managers leave their previous firms that have everything, from doing the finances to the IT and everything. I think it's just fun to be sharing that journey with them. And that's why I love working with emerging managers. It's fun to look at a blank canvas and kind of be a very, very, very small part of that.
No, you've been a big part, Jordan. You've been a great support. I know the Private Equity Women's Network has been fantastically supportive of you and all your work for them. So thank you.
Well, PE Win is, they were we started working with them in 2020, and it was important for us to do that because of my wife, Jing, who's now full-time and co-founder of 51 Labs. She was just going through a rough time in her career. And that's one of the reasons why I started doing so much of my content on investorsandoperators.com focused on women, to say like, hey, here's an example. Here are different examples of content I've shot. Like, listen to their story. Hopefully that provides you some inspiration. I think she was just stuck in a rut and needed to get out of it. So like discussions like the one we're having are, very meaningful. And I just feel very lucky that, my day-to-day job is to have fun, interesting conversations with people like you. This is awesome. Thanks so much for the time.
Thanks, Jordan. Take care.